Morning, everybody. This is Frank Boudelet, partner in financial services based in our East Brunswick office. Hopefully we can clarify some of the things that are floating around and some of the maybe misconceptions, but we'll note for this that there are a lot of different interpretations to a lot of the things that we'll be talking about today. We've done a lot of research to see what others are saying, large banks, other large firms, and we think this is the position that will best be when all the regs come out at some point. So today's webinar, we're going to cover the SBA assistance available. We'll talk about the SBA Economic Injury Disaster Loan Program, which is one alternative. And we'll also talk about the Paycheck Protection Program, which is another. And we'll have and then the key to this, we're going to do a sample calculation at the end to walk through an actual calculation under the Paycheck Protection Program based on the formula that you will use to get a loan, and then how much will possibly be forgiven. And then, yes, we'll have some question and answer. So you send in your questions and we'll do our best to answer what we can. What we can't answer, we will spend the next couple of days just gathering those questions, answer them, and send them back out to you. So without any further ado, I will turn it over to my partner, Tom Reck, who will talk about the SBA EIDL program. Tom, take it away.
Thanks, Frank. Hello, everybody. This is Tom, partner at Withum in the Forensic and Valuation Services niche. As was mentioned, there are different alternatives available to businesses from the SBA. The alternatives that are available are a result of the passage of HR 748 this past Friday. And that legislation has caused there to be fundamental changes to the SBA itself. So if you have dealt with the SBA in the past, some of the things you will hear today are likely to be different than what you're used to hearing. So if we want to take a look at the SBA EIDL page, Matt, are you able to move that? Okay, so we're on the SBA EIDL page. What you'll see is that this EIDL stands for Economic Injury Disaster Loan Program. And what it's designed to do is it's programmed for businesses and not-for-profits to assist them with their working capital. The money that would be obtained from the EIDL can be used to pay fixed debts, payroll, accounts payable, and other businesses' expenses that cannot be paid as a result of the downturn in the economy from the COVID-19. Now, it's interesting to note that although much of the language in the bill discusses payroll, it's important to note that it is also geared towards proprietors, self-employed individuals. So don't assume that if you are paying someone through a 1099 that they're not covered in this, because they would be. The EIDL is aimed more at sole proprietors, independent contractors, as I said, with less than 500 employees, okay? And the maximum amount of loans that is available is $2 million. That $2 million amount is determined by the SBA itself. So one of the things that's interesting and should be noted is if you were to apply for the SBA EIDL monies, you would be doing that directly through the SBA itself, and that money would come from the SBA. If you were to obtain monies and apply for loans through the PPP, which Frank will be talking about next, that would be done through a lending institution that's affiliated with the SBA. What's nice about the EIDL is that $2 million, the maximum amount of $2 million, the interest rate on that is 3.75% for businesses, 2.75% for not-for-profits, and the term is up to 30 years. And as I had mentioned earlier, if you've dealt with the SBA in the past, there are certain things that are different now than you're accustomed to. So for example, one of the things here is typically the SBA would only loan money to businesses that could not obtain credit elsewhere, and that's known as the credit elsewhere clause. For purposes of the EIDL, that credit elsewhere clause has been waived. So even if you have the availability of funds from other sources, you can get it from the SBA. Typically, an applicant would need to be in business for 1 year in order to avail themselves of an emergency loan, but that is not the case here. As long as the business was operational by January 31 of 2020, it can apply for the loan. And in addition, the SBA may approve an applicant based on the credit score of the applicant and will not require the submission of a tax return for 2019. So if the return is not done, that should not be a stumbling block for an entity looking to get a loan. So if we could flip to the next page. We have the emergency grant of up to $10,000 that would be paid within 3 days after applying with the SBA under the EIDL program. Now, in order to get that $10,000, you will have to sign a certification that indicates that that $10,000 is going to be used for business expenses. Those business expenses would include paying for employees during the slowdown of a business as a result of COVID-19, meeting any increased costs that a business might have incurred as a result of COVID-19. So think in terms of you had to spend money on updating some of your technology so that folks could work from home. That would be a cost that would be covered here. Making rent or mortgage payments, that would be covered here. And essentially, as the language says, any other business obligations that cannot be met as a result of the revenue loss attributable to the COVID virus. There's a 3-step process to apply. So again, the EIDL, that loan is actually made, that application is with the SBA itself. So you would go to disasterloansba.gov. You could do it online. You can also do it by mail. I understand that there is an in-person availability, but where those places will be that you can go, I'm not sure at this point in time. And it should be noted that the SBA is kind of catching up to this itself. This bill was just passed on Friday. It has 48 hours to essentially get up to speed. Okay. Now, the additional information that would be required would be, there's a form 4506 that has to be required if you have a business in which you own 10% or more. I'm sorry, 20% or more of a business. Personal financial statements would need to be provided. Copies of recent federal income tax returns would need to be provided. But again, if you don't have the 2019, that's okay. That's not going to be a stumbling block, as I had indicated earlier. Okay. Now, what will happen is the SBA, they will actually take a look at the information that's being submitted. So once they look at that information, they are going to determine the amount of the EIDL loan to which you are eligible. So it's not like the PPP program where there's a formula that's established. This is completely different. It's set by the SBA. There'll be a loan officer that will be involved. They'll actually look at what your needs are, what your eligibility is, and then the whole process should take about 2 to 3 weeks to get everything done. Now, if I go to the next slide. Okay. So what will then happen is within 5 days of receiving the form disclosure, you should be receiving your first rounds of checks. Now, what's interesting about the EIDL2 is it's up to $10,000 is the grant that people are discussing. So I know a lot of people have been saying, oh, well, if you apply for the EIDL loan, you're going to get $10,000 right off the bat and it will be forgiven. That's not necessarily the case. It's up to $10,000. That money has to be used for the intended purposes, as I said, paying for payroll, um, uh, meeting any other costs that have been incurred as a result of the downturn. And if you do receive the EIDL monies, essentially what will happen is that money will then be considered as a reduction of any loan forgiveness that might result through the PPP, which Frank will discuss next. Frank?
Yes, Tom, sorry. Just trying to log back in. Okay, so so the 7A loan under the Paycheck Protection Program. Next slide, please. Okay, so this is a loan that you apply directly through an SBA lender, typically your bank. So the thing I'll say is reach out to your banks today. Call up your banker that you have a relationship with, start there first. Had some questions, what if I don't want to use my banker, I want to go somewhere else? Just remember this, that another lender may not know you, and we'll have to get an understanding of your financial capabilities of paying back the loan at some point if it doesn't get forgiven. So my recommendation is use your current bank, start there first, start that conversation now so that you can get that going. We're hearing that the banks are just, the way this worked was the SBA had 48 hours when the bill was signed on Friday. So by Tuesday, they have to be ready to go and give all of the directives to the banks. They may open it up to more banks that were not approved to be SBA lenders. So that's happening now. The banks are telling us that they're going to need at least a week to get through the process. Some are larger banks are telling us that it may take till May before monies can be given. So what the one thing that Tom alluded to was that $10,000 grant that you can get. A lot of our clients are now going in and applying for that $10,000. It's a real simple process to get it. You go online, you fill in some questions. Took about 5 minutes, and then you got bank account information right on there. So the way they're going to do it is going to drop the $10,000 into your bank account, and then I think you get the other forms sent to you to fill out to get for the full loan. So on this program, any business that is under 500 employees will be able to qualify if you, and then it also includes, you look at the your NAICS code, because the small business is defined by the SBA under that code, and they have a standard size document. We have it on our website, so you can look that up to see if your business, for example, if you are code 33311 machine manufacturing, you can go up to 1,250 employees to be considered a small business. So therefore, the 500 doesn't matter to that entity, the business in that group. You'll go up to 1,250. So if you have 1,250 employees, you would be able to qualify for this as a small business. It includes proprietors, independent contractors, self-employed individuals. Includes businesses with industry code 72 that have multiple locations. So that's the accommodation and food services. So if you do have you are in that, you're in a hotel and you have a lot of locations, in total you're over 500 employees total company-wide, they're going to look at each location to ensure that you have less than 500 employees. The other thing I'm going to mention here is the affiliation rules, because that's what this falls under. The affiliation rules, what we're hearing is that if you are, say, a VC or a private equity fund, all the portfolio companies underneath that fund may not be able to apply if there's total more than 500 employees for all those entities. A letter went out from the NVCA to Congress on the 27th, basically saying, guys, I think you're excluding all these startup companies and portfolio companies, and the government hasn't responded. What we're hearing is that the government, Congress, believe that those entities have access to capital through the investors in the funds. So they're really trying to get to the people that really need the money, that have no other resources. Okay, next slide, please. So this is this covers, the covered period is from February 15th to June 30th. That's when they decided, I guess the disaster was declared on March 13th. They went back to February 15th And that's the period of time that a lot of the information that you're going to be gathering will be used for the calculations. Payroll cost covers employees up to $100,000. That was another question last week. And the way the law is written, it's not clear whether it means employees over 100,000 are excluded. You can't get any money from them, which makes no sense. Or salaries up to 100,000. We believe that the salaries up to 100,000 prorated for the covered period will be used for your for the calculations. It includes salary, wages, commissions, tips, vacation, parental, health insurance, retirement benefits, sole proprietors, independent contractors, again, up to $100,000 annually. So you can also apply. We're not exactly sure if, because 1099 people for a business, if you're paying somebody on 1099, and that's how your business operates, typically you hire independent contractors, you can apply for reimbursement for them. I'm not sure how there's not a double dipping going on. So again, not sure if they thought this all the way through. This excludes any qualified sick leave. So if you're getting qualified sick leave under the Family's First Coronavirus Response Act, you can't then get that money on this side either. No double dipping. Next slide. So the maximum loan is going to be 2.5 times or 250% of the average monthly payroll costs incurred during the 1-year period before the date on which the loan is made, plus any outstanding loans under the disaster relief. Now, one of the things that we're getting a lot of questions on, can you apply for both the disaster loan that Tom talked about and this loan? And the answer is that we're seeing is yes. As long as the funds from the EIDL are not used for the use of this program. So if you're covering the cost, as Tom mentioned, a big cost a lot of people will have was the cost of technology. If that's what you're using the money for, to ramp up for that, as long as it's not used for payroll, it will be fine to do. But if you start using it to cover payroll, then you're going to be in violation of this loan provision. The one thing I'll say here before I go on that I just want to read this, that the borrower requirements, certification, an eligible recipient applying for a covered loan shall make a good faith certification that the uncertainty of current economic conditions makes necessary the loan request to support the ongoing operations of the eligible recipient. That's something that each business owner is going to have to determine. That's more of a legal question. We don't have the answer, but if you believe that you have negative economic conditions have hurt your business, then you can apply for this loan. Next slide, please. Here's the allowable uses: payroll costs, costs for continuing health insurance, payments of interest on mortgage payments, not the principal. So when you're calculating the uses, and this will be for the forgiveness, they're not going to count the principal payments on the loans. They're only going to count the interest. They're going to count the rent, and they're going to count the utilities. Next slide. So now there's a waiver of personal guarantees. There won't be any personal guarantees required. Collateral is waived, and there's typically fees that the SBA would charge between 1% and 2% of the loan, and that would go to the bank. That's all waived. The SBA will pay the banks directly based on the amount of loan. 100% of the loan is guaranteed by the SBA. It'll be a 10-year term. So when we walk through this later when Matt goes through that, whatever's not forgiven can turn into a 10-year loan, which will not exceed interest rate of 4% for that time frame. So once you get the loan forgiven and the amount that's forgiven, whatever's left over will go over 10 years. The lender will provide a deferral of principal for up to 12 months. And we talked about the recipient on the EIDL. So next slide. Loan forgiveness, we've got through that example. So it covers an 8-week period beginning on the date of the loan origination of the loan. There's a lot of information out there. We're seeing some information coming out that kind of alludes to it's any 8-week period between February 15th and June 30th. We're not really sure. That's not how the law is written. The strict letter of the law is exactly as it's here. So it would be an 8-week period when you get the loan. So if you get the loan on May 15th, you have an 8-week period. Now, obviously, that's going to go past June 30th. So we're pretty sure that you're going to be using that 8-week period from May 15th to July 15th to look at those costs that you paid. Amounts eligible are, again, payroll costs, interest, rent, and utility payments. Next slide, please. The amount of loan forgiveness shall not exceed the principal. Obviously, you're not going to get forgiven more than you got. The reduction of forgiveness is based on the number of employees. So what they're looking for is how many employees you had before the disaster occurred, and how many employees have you retained. So that's the first level you're looking at, that percentage. So if you had 10 employees before the disaster, and during this period you let 2 go, so you retained 8, 80% of the amount of that you paid out as expenses will be forgiven. The rest you'll have to pay back. Again, remember, you're getting 100% or 2.5 times, but they're using 100% of the salaries to use the calculation. And on the back end, you only had 8 people you paid, so obviously you're paying less. So you'll have to pay some of that loan back. The second part of this, which is an and, not an or, is they also look at the salaries and wages. And if you've reduced anybody's salary more than 25%, like somebody's making 80,000, you drop them down to 40. What they will do is they will penalize you for that, and they'll only allow you won't get forgiven the amount above the 25% differential. So in that case of 80, 25% would be 60. So anything less than 60 wouldn't be forgiven. So you paid 40, you wouldn't get that amount forgiven. And again, employees over $100,000 are not using that calculation because I guess the government doesn't care for people over 100 whether you reduce their salary or not. Next slide. There is a rehire provision in this, which makes a lot of sense. If you decided at one point, this is in March when this all occurred, you let some people go because you do not have any money to pay them. If you hire them back by June 30th, you will not be, those calculations will be amended, and you won't get penalized for hiring them back. Just remember though, if you're hiring back on June 30th, there's probably no cost in that period that they're going to be using for how much payroll, how much cost you actually paid. So you may need to hire them back sooner than that to get the full forgiveness amount. But the whole purpose of this act is to get money in the hands of the employees. They do not want, I believe they do not want any businesses to benefit more than they would have if business went on as usual. So just if you keep that in mind and do everything that way, I think you'll be fine with the rules. If you are trying to get excess money to run your business, then you may be, and if you're in a growth mode, you may have a slight problem there. So just be careful, and you may need to speak to your attorneys about the definitions of if you were impacted by the virus. Next slide, and then these slides here. Keep going. Next slide. So state and local, New York City has a program. I'm not going to talk about this because we really want to get into into Matt's example. So the next couple of slides, and Matt, you can go through each one. We have Philadelphia, Florida has some information. Los Angeles and San Francisco also have provisions. So if you are in those states, reach out, look at those states' websites. You can reach out to us. We put the websites on the bottom of each one so you can look and see what they're doing. Some of those have changed. The Economic Development Authority, as of yesterday, changed. They're giving out some money up to $5,000 for businesses under 1 to 10 employees. Again, they're all trying to move quickly to get money in the hands of the public so that people can not feel like they're lost and don't have money. Next slide, please. I think this is Matt now giving us examples. So Matt's going to walk us through an example is what our interpretation of what the rules are, so you can see actually how it works. So Matt, you want to take it over, please?
Sure. Thanks, Frank. Hi, everyone. Matt Walsh. I'm a manager within our Princeton office. Happy to be with you all today and kind of walk through. So before we get started, I do just want to kind of go through a quick disclaimer. So as Frank and Tom have both alluded to, the current situation is that we have a law that was passed, and similar to the way that the IRS interprets the law when tax laws are passed, the SBA has now been charged with interpreting the law as the way that it is written and will be providing regulations. We're hoping, as Frank said, within 48 hours that those regulations are released. The way that we have set up this calculation is to calculate it based on the letter of the law. On our SBA financial assistance team, we have CPAs, we have fraud examiners, we have attorneys, and we have people from our advisory group. We have all kind of come together and understood this law and read through it many times, and this calculation is a result of that. It could be that the regulations change, that the SBA interprets it differently, but we're going to kind of run through that, and we'll kind of tell you where the unclear areas are. So The only other thing that is not certain at this time is how much leverage the individual banks are going to have in carrying out this process. The way that the law is written, the banks will be overall, the approved lenders will be the ones that are carrying out this process, and it's not clear if the SBA is going to give them formal instructions and calculations or if the banks are going to be responsible. So that's open as well. So the first thing that we kind of talked through, and Frank already alluded and touched upon the different calculations, is the maximum loan amount. So what we've done here is we've created a case with 3 individual company, just to kind of keep things simple and hopefully keep everybody following along. With this company of 3 individuals, we've already assumed that they've met all the qualifications under the other. We've assumed that they've been injured by the COVID-19, and we're assuming that they are going forward and applying for this loan. So the maximum loan amount, as we talked about, is 2.5 times the average monthly payroll costs for 1 year before the loan is made. Again, there is a qualification if you weren't in business for that full year that you would select a different period, but that's kind of the general calculation. Added to that, you have any outstanding principal of an EIDL loan previously issued, and you kind of come to your total loan amount. So I guess the first question we have here is, well, how do we calculate that average monthly payroll cost, that 21,833 number? So the next slide is going to kind of say, well, how do we get there? So the way that the CARES Act reads, here's the definition, and this probably looks a little small to you. And as we expect with any law that's passed, it's clearly a very simple calculation. We're actually going to break this down a little bit. This slide basically takes all of those items that Frank talked about earlier and kind of builds them out. But we're going to make it a little bit more simple here. So we're going to assume that for these 3 employees, they have standard salaries, right? And we have additions and our reductions. So for employee 1, 2, and 3, we're assuming employee 1 makes 150, and employee 2 makes 90,000, and employee 3 makes 90,000, employee 5 makes 72,000. So this is their overall salary, wage, commission for the prior year, right? We are interpreting that the law says that compensation, well, the law does say compensation of an individual in excess of an annual salary of 100,000 as prorated will not be included. So what we've done for the person who makes 150,000, the first thing we've done is reduce them down to 100,000, right? So when you're calculating your payroll costs, it's expected that we're going to have a limit of $100,000 per employee, which calculates out to $83.33 and 33 cents per employee. So if you're starting to think about whether or not this applies and how this is going to apply, if you do have employees that make over 100,000, their payroll costs are going to be limited to that 83.33 per month, right? So what we've done is then we've calculated this across each of the employees, and we come up with that number of 21,833. So when we come back here, that's how we got to that number of 21,833. You multiply it by your 2.5 times or 250% multiplier, and you get to that 54,583. So moving forward from here, our maximum loan, right, that this company would be eligible for is 54,583. Now, if you do this math for your company and you come out in excess of that $10 million, right, the limit will be $10 million. So you can't go above that amount, okay? So after we calculate the total loan amount and keep that number in mind, that 54,583, that's going to kind of continue to come up. We have our second provision, which is our loan forgiveness calculation. So this is the big, piece that many companies are interested in, and unfortunately, this is one of the bigger areas that we're seeing a lot of communication out there. I think when the law came out, a lot of interpretations came out, and there was a lot of things in the news from different Congress people and different groups that were interpreting this. And what's coming out as a result is we're seeing a lot of questions around this. And, the questions are very similar in nature, but kind of, go along the vein of I heard this and I heard that, and that doesn't make sense. And, this is kind of different. So again, what we're doing here is taking the way that the law is written and interpreting it as literal as possible, because that's the way that we think that the SBA is going to come down with the regulations, because they have to follow the law that was written. So the loan forgiveness calculation takes into consideration expenditures that you spent during the 8-week period for forgiveness. Now, The loan, if you recall, was calculated on 250% of your monthly average payroll. So it is expected that some additional costs will need to be incurred over an 8-week period, right, which is less than 2.5 months, in order to get to your total. So in this case, what's eligible to be forgiven is your payroll cost spent, your interest on mortgage obligation spent, and note that the mortgage obligation has to be on the books as of the beginning point in the period. You can't enter into a mortgage obligation now and then include the interest. It also includes rent expense and total eligible utilities expenditures during this period. So in our example, the company spent $43,500 on eligible payroll costs. They spent $10,000 on eligible rent, and they spent $2,500 on eligible utilities. So across the 8-week period, they were eligible to have $56,000 forgiven, right? And that's the starting piece, right? Well, as Frank said, we can't have a forgiveness amount that's in excess of the principal balance that we received. So our starting point here for what can be forgiven will be limited to the lesser of the amount of expenses that we have incurred or the $54,583 loan amount that we got to begin with. So in this case, we're limiting it down to the $54,583. There are then two provisions that relate to the limitations on the forgiveness, right? The first one is our workforce reduction, and the second one is our payroll amount reduction. And Frank kind of explained these at the onset, but I'm gonna get further into them as well, right? So our first provision for forgiveness relates to an FTE decrease, right? The workforce reduction. So if we look at this highlighted 4962, that is equivalent to 9.09% of the 54,583. So how do we get there, right? So the way that the law is written, right, there is a FTE comparison. So you would take your full-time equivalents during the covered period of the loan, and we're assuming for this case, all the way on our left side here, that our covered period of the loan is 8 weeks from the date of the loan. All right, and again, as Frank said, that there is a little bit of interpretation there that we're expecting. But this is the way that we're expecting it to fall out. So the way that you calculate your average FTEs over a period as defined by the law is you take the number of FTEs in any pay period that you made, right, during the covered period, and you calculate the average of those. So in our example, right, we are assuming we have 4 pay periods in that 8-week period, right? So across that 4 pay periods, we had 3 FTEs in each of those periods. So we have an average of 3 that we're working with, right? So then we compare that against the prior period FTEs. Now, if you think about it, the spirit of this is to make sure that employees are continually being employed. So the way the law is written, it allows you to pick an option between 2 specified areas of what your comparison will be. So the way that we're interpreting it, you would want to pick the more beneficial option to you. So the 2 periods that the law allows is February 15th, 2019 to June 30th, 2019, which is essentially the same period that the entire legislation covers, right? Just 1 year previous, or at the option of the borrower, January 1st, 2020 to February 29th, 2020. So again, the way that this calculation is done is very similar to the way that we went through the first one. We took a look at all the pay periods that we had, right? We included the number of FTEs for each pay period, and we performed an average, right? So in our first option, the February 15th, 2019 to June 30th, 2019, which is the middle here, right? We had an average of 3.3 FTEs, right? In our second option period of January 1st, 2020 to February 29th, 2020, we had an average of 3.5 FTEs. Well, in comparing those 2 option periods to the 8-week period that we had from the onset, right, the more beneficial way to look at this is the one with the lower average FTEs. So we have theoretically reduced our FTE count between the covered period and the comparison period by 9.09% or 14.29%. So we're going to go ahead and select option 1 here to reduce our overall forgiveness amount by the 9.09%. And again, the spirit of the law here is to keep everybody employed. So if your FTEs do not decrease between last year or either of these covered periods to now, right, to the period from when you get the loan forward, then you won't have any reduction as it relates to this. Now, again, this is a period, this is an area that is open for interpretation. As Frank said, we've seen multiple different reports out there that say the covered period should be this or should be that. We're going by the letter of the law, right? You know, one of the hangups here is that the legislation itself uses the term covered period in quotations in different sections for different things. What the term covered period means in section 1106, which is the loan forgiveness section, is the 8-week period following the date of the loan, which is why we're taking this stance right now. Again, subject to interpretation as the SBA regulations become available, we will obviously update our understanding. We will continue to, you know, update the way that we are looking at it and disseminate that information as available, right? So we calculated the 4962, right? The 4962 was 9.09% of our overall 54,583 reduction, right? So the next one is the next limitation on the forgiveness is the payroll amount reduction. So this is the salary and wage reduction. So again, this is another schedule that looks you know, pretty onerous when you look at it from an overall level. So what we're going to do is we're going to break this down into 2 parts. The first part of our salary reduction and how we calculate is to take a look at who should be included. The definition of an employee directly from the law when it comes to this section is that any employee who makes less than $100,000 on an annual basis needs to be considered. As Frank mentioned earlier, we believe that this is because the spirit of the law is based on assisting those individuals who make less than $100,000. So for an individual who, in our case, employee 1, who was making $150,000, right? The government is okay if you reduce their salary down to $100,000, just provided that you're not also reducing the individuals who make less than $100,000. So in this case, right, what we look at is we look at each individual's highest gross salary on our left column, right? The way that the law is written, the employee's highest gross salary or wage in a single 2019 pay period amount. So this is basically taking their highest salary amount. So if that is, you know, what they made at the end of the year on an annual or on a per paycheck basis, you would multiply that by the number of pay periods that they had, and you would get their annualized salary. In our circumstance, we had 3 employees, right? Our first employee who made $150,000, it's our understanding that we do not need to continue this analysis for this employee. Should we drop their salary down to $100,000 or $75,000, that may be more than the allowable amount. But remember, the government is making sure that we're taking care of those individuals that make less than 100,000. I will add one note here just to be careful because, you know, as a reminder back to when we were calculating the overall payroll costs, the individual who made 150,000 was limited to 83.33 1/3. So if you do drop that person's salary below 100,000 and you don't spend that on payroll costs, you do have to make sure you're spending that elsewhere to be eligible for forgiveness. So in our scenario, we are moving forward with this analysis to part 2 for the 2 individuals, employee 3 and employee 5. Okay. So in part 2 of our calculation, what we're going to do is we're going to take a look at what we are paying them before the COVID-19 effects and after, right? So in 2020, during the 8-week period, we're, you know, again, we're not doing this analysis for employee 1, and employee 3 and employee 5, we're looking to see, okay, so what were we paying them previous to this situation, and what were we paying them during the 8-week period? So in our leftmost column, the per period salary and wage during the most recent quarter, the law defines this as the most recent completed quarter, what they were making, right? So in our scenario, employee 3 and employee 5 were making $37.50 and $3,000. Well, across our 8-week period, we've paid each of these individuals a little bit differently. Employee 5, we kept the salary the same. We continued to pay that individual $3,000, but for employee 3, we dropped their salary down to $2,000 per pay period. So on the second half of our analysis here, where the salary reduction column is, what we've done is we've said, all right, well, let's take what we had 4 pay periods during the cover period. Let's take what they would have made under normal circumstances. So for employee 3, if you take your 3750 times 4, you get 15,000, right? And for employee 5, if you take their 3,000 times 4, you get 12,000, right? So let's compare what they made, right? What they would have made during a normal operating year against what we actually paid them during this period. And if that number drops by more than 25%, that's when the SBA says, no, you're no longer allowed to take the amount that exceeds 25%. So in our situation, employee 3, we continue to pay them the salary, right? There was no reduction in salary, right? So we're not penalized at all for that person. But if we take a look at employee 3 specifically, right, they would have made $15,000 under their normal salary. But during this period, we were only able to pay them $8,000, which led to a reduction in pay of $7,000 over the period, right? So in this scenario, when they make $15,000 normally, 25% of that $15,000 number is $3,750, right? So theoretically, this individual's salary could be dropped to $3,750 before the SBA penalizes you from a loan forgiveness perspective. In actuality, what happened was we reduced their pay $7,000. So the reduction that was in excess of our 25% was $3,250. So in this case, for the reduction of employee salary, we are going to reduce our forgiveness amount by $3,250. And it looks like my last slide got cut off, so I do want to pull us back just to the loan forgiveness calculation, right? So in this scenario, right, we started with a loan of $54,583. We had expenditures that were in excess of what our loan amount was. So our forgiveness base was $54,583. Then we went to our limitations. Our workforce reduction, we had a reduction of 9.09%, leading to that $4,962. For our payroll amount reduction, right, we did not consider the individual who made more than $150,000. We considered, or more than $100,000, I'm sorry. We considered the 2 employees that made less than $100,000. For one of them, we did not reduce their salary. We kept it the same. So we were not penalized. For the other one, we reduced their salary in excess of 25%. So we reduced for $3,250. Our total limitations were $8,212, which led us to an eligible amount for loan forgiveness of $46,371. So based on our understanding of the law as it's written currently, a company that in this scenario that received $54,583 would have $46,371 forgiven, and the remainder would continue on into a loan at a maximum of 4% interest. As Frank said, the loans are required to give on all PPP, the banks are required to give on all PPP loans a minimum deferral of no less than 6 months, no more than 12 months. So it could be the case that you would not need to pay anything until after you have done the forgiveness calculation. We've also received a few questions surrounding, okay, when is the forgiveness calculation done? So again, this is waiting on the SBA regulations and how it's actually going to be run, but the way that the law is written, it says that such calculation and such application will be done after the 8-week period. Okay, so with that in mind, I think, as I said at the onset, I just want to reiterate it again. The way that this is calculated is the way that we are interpreting the law. It could be the case that the SBA regulations come out and say something like, well, you don't need to look at it on an individual basis, but look at it on an entire company basis. We just don't know. And we want to make sure that we took kind of the most conservative route, which is look at it on an individual employee basis, make sure that you have, all of your ducks in a row, so to speak. And we wanted to make sure that, we kind of gave you the letter of the law while still letting you know that there are some other additional interpretations out there. So with that being said, I think that's it for the actual calculation itself. Frank, I'll turn it back over to you to address some of the questions that have come in.
Thanks, Matt. Good job on that. Hopefully you can follow through that example. Some of the questions we got, number one, the EIDL, the Economic Injury Disaster Loan, that is applied directly from the SBA. That's the one where you can get the $10,000 grant. That possibly could be rolled over into the Paycheck Protection Program loan, which goes directly from the bank. So the PPP loan we've been calling is the Payroll Protection Program, PPP. That's done through your bank. Okay, so that's where you apply for that. One question came in about ownership. It's 20, anybody applying for loan, anybody on over 10% has to give a personal financial statement at some point. All people that are included, employees, only U.S. citizens on your payroll will be used for these calculations. If you have somebody in a foreign country that's on your payroll, they are not included in this calculation. The affiliation rules, some questions around that. Now, one thing I'll say on the affiliation rules for franchises, I mentioned earlier about what they're looking at industry codes, over 500 people. If you have a franchise, and on our website, we are putting on the SBA franchise directory. You'll look up there, your company, if it's a franchise, will be listed there. You'll have a franchise code. You are then allowed to if you have more than 500 people, still apply for this loan, provided that the individual locations are less than 500. So now another question on the private equity. Again, the private equity right now, as we read it, the affiliation rules go by control. So they're assuming that the private equity fund is controlling those portfolio companies, and they are the ones that have the money to supply to the individual companies. So again, up in the air, there was a Wall Street Journal article about that, and the interpretation and what they said was that it looks like private equity VC funds are in trouble. If you have a family office, and the family office controls, have many entities within that family office that is owned by the main owner, you look at the total employees. So again, over 500 for all of the entities. The way it's written right now, it would be excluded. Now, we just found out that the U.S. Treasury will be coming out with regs tonight. So hopefully some of these things that we're looking at may change. Some questions on the 100,000. It's up to $100,000 of salary gets included in the things that we were talking about. If you have an employee making over 100,000, that amount over 100 does not get included. It's it's prorated for this 8-week period. So you can't pay somebody $100,000. What's that? $15,000 a week, and it's over 100. It's only prorated, so it will be $8,333 a month is what you'll be using for that calculation. So I'm thinking I'm trying to find some more questions that are similar. Again, now for not-for-profits right now, 501c3s are in. 501c6s, associations, do not seem to be addressed in this guide. So we do not believe that they will be able to, apply for the loans. See here. The EIDL, the Economic Injury Disaster Loan, is up to $2 million. That's determined by the SBA. The only one that the calculation for formula is for the PPP loan, which is really for payroll protection. So that's the one based on payroll. So if you apply for the EIDL, they're going to look to see why do you need the money? So you have to describe what your loss was, why you can't meet your obligations, and what those obligations are. So you'll be sending in some information around your accounts payable and any other bills that you cannot pay. And that's the information that they'll make their determination. So they're going to determine that. But on the PPP that Matt just went over, that one it's a formula driven, where we'll hopefully get more guidance exactly on all the items that we have some questions on. I think, Tom, you have any questions you want to address, or?
Yeah, there's been some question as to whether if you're using someone who is not a waged employee, but rather someone who's getting a 1099, does that person apply to, in the mix? And the answer to that, as I read it, is yes. Specifically, the language says salary, wage, commission, or other similar compensation. And then it talks about, on the next section, compensation to or income of a sole proprietor or independent contractor. So yes, I believe that payments to independent contractors, sole proprietors are covered under this bill. The intent is that they'd be covered under this bill. But again, the $100,000 limit would kick in just as if it was a regular wage.
Good. And there's a question here: if you rehire, do you have to rehire the exact person? And the answer there is, I don't know. It doesn't talk. It talks about the number. I think the question came in: what if we ask our receptionist not to come in anymore, and then she gets a job somewhere else, and then we replace that person? I think that's okay because you're hiring somebody back. So again, this is to keep the employees working or getting paid at least. And another question came in: do they have to actually work? The answer is probably not. Again, that's more of a legal question, but I think at the end, when you think about the spirit of this bill, they want to get money into the hands of the people that we're working, so that they have some money, so they don't feel desperate and lost, and they can pay their bills. So that's what I think when I look at this, and I get a lot of questions asked. I always look at it, well, what's the spirit of what this is all about? I think that's all the questions that I see. We have a lot of questions here. A lot of them are similar, so I hope we covered most of them. What we will do is we will try to get back to you on all of these questions as best we can, as quickly as we can. But we may want to wait until the regs come out from the Treasury tonight, so we might not get back to you until tomorrow. But the thing I'll leave you with is call your current lender and ask them for the application that you want to get the loan under the PPP. The information that you'll need, we have it here to do is call the bank, get your financial statements in order, get 3 years of financials ready, get your personal financial statement for owners over 20%, the last 3 years of tax returns, get your payroll monthly. Like I said before, as you saw with Matt's calculation, if you can get that information, it's going to be easier for the bank to determine how much you get. Now, we don't know how the bank's going to handle that. We don't know if they're going to sub that work out to somebody else, but they may, because I can't imagine that bank gets thousands. They're going to handle that process. Things that we're asking our clients to do is that they can get this information and get it all to, and then get back and with the application start the process. That's my closing remarks. Tom, Matt, closing remarks?
Yeah, I would suggest to folks that if they are in dire straits, and maybe that's too strong a term, but if someone has been significantly impacted as a result of COVID-19, I would not waste any time applying for the EIDL monies. Worst comes to worst, you get up to potentially a $10,000 grant that you won't have to pay back. You may get some monies up front from the SBA to cover some of your needs, and in addition to that, that ultimately can be rolled into the PPP at the end of the day. So I would encourage folks, if they are feeling significant impact from COVID-19, that they avail themselves of the benefit of the EIDL.